right, good morning. Let's kick it off, guys. Um, socket, pokey, socket. Okay. Yeah, a great session last night out of the S&P again. It was incredible reversal that we've had here. 3 out of the last 4 sessions, really pushing up toward new highs. Or sorry, not toward new highs, but back up toward the highs. If I'm not mistaken, we're only about 20 odd points away, 30 odd points away from all-time highs in the S&P. You can see there every sector across the board really running. And yeah, I mean, obviously yesterday we had the Federal Reserve meeting. It was the first time we really had Janet Yellen speaking, and her comments on monetary stimulus really actually being less dovish than some people thought she might be. And the market really took that as a positive. I think it was, I think for her, or for the market, it just reiterated the fact that, we are, the economy is recovering, and the market took it that way and really pushed to new highs, or pushed to the highs of the day. We also came to a new agreement to raise the debt ceiling yesterday. The House passed the bill yesterday's session, and it really kind of happened without a real struggle. So I think that's also kind of a big positive for the market that was overlooked due to the fact that Yellen was speaking yesterday for the first time. All right, today's action. In Asia, also very bullish. You can see they're up over 1% in the Hang Seng, up over 1% in Australia. Shanghai eked out a gain after some better than expected trade data. Nikkei was up a bit, even though there's some disappointing data there. So all in all, relatively solid session out of Asia, but not nearly as strong as the U.S. session was. All right. Today on U.S. earnings season, we've got Mondelez International, we've got Cisco Systems, we've got MetLife after the bell. We've got lots of data out today. We had a lot of stuff out of Japan earlier, like we said. We had the Chinese numbers, which are also better than expected. Then we've got French current account balance. We've got industrial production out of the Eurozone. We've got retail sales here locally. That's going to be one to pay attention to at 1 o'clock. We're looking for 2.8%. So we'll have to pay attention to that at 1 o'clock. And then we've got mortgage apps later in the States. All right, before I jump into anything, I'll just take the slide to use this as an opportunity here, and I'll just paste on a little chart for you guys there. That's the chart. It's an overlay of 1928 to 1929 with 2013 to 2014 overlaid. That's before yesterday's session on the S&P. This is kind of what the hottest topic of the market is at the moment. There's a gazillion guys that have been talking about this. I think the one thing that really kind of doesn't parallel is the fact that you've got dozens of market participants, from Tom DeMark to Doug Cass to Mark Holbert to, everybody you can think of, calling for a market crash at the moment. So I've never remember hearing of a crash coming when everybody in the market was calling for it. So I think that could be the one differentiator, and I think that this is something to pay attention to as we go forward. Like I said, I think so long as everyone's paying such close attention to it, it probably won't happen, but just keep it in mind. It's out there. It's one of the biggest topics of conversation, and the reason why I'm pointing it out, we always talk about how we want to pay attention to how the market's positioned. That's one of the things that's most important to you in your trading day. Locally, I wouldn't say that it's necessarily the case, but I think in the States, for instance, I think there's a lot of people that are short, specifically on the back of this kind of chart. So I think that's one of the reasons why the last 3 out of 4 days we've had such a big rally in the U.S. on relatively benign information or data. So I think this is very important to realize, and that a lot of the guys are playing the shorts here, and we're probably going to get a squeeze before we can go lower. All right, let's jump into the maps here. The first one I want to have a look at is the U.S. dollar ZAR. Okay, a reason why I wanted to show this, simply because I'll take it forward a little bit, but it's simply because it's the first time since mid-January that we've had a close below 11. We closed below 11, and this is after 2 or 3 attempts to try to pop back through that level. It didn't trigger a whole lot of stops like I thought it might and really kind of run to the upside, but I think the longer that it continues to push to the upside, the further it'll probably go. So just keep that in mind. This is obviously a very volatile time for the rand. We can have big moves, and playing in the rand hedge stocks, I think now that we've broken through 11, just comes at it even more of a risk than it previously would. Bottom line is that we really are flagging in this pattern. Any bounce here in the rand, really, to be honest, is probably to be sold at a point. The rest of the market will probably be thinking that, especially if we were to get down to 10.5, where I think we really kind of made a breakout from about a month and a half ago. That would probably be an incredible level to look to reshort the rand, and that's probably where I would see this thing maybe going in the short term. But all right, let's have a look at Tiger Brands. Tiger Brands yesterday finally gave us a nice little drop. It could never really regain the support on this flag pattern. If you look here, if we did get a couple of rallies, a couple of days of outperformance, could never really get above that support line. And then yesterday on weak earnings, or slightly weak earnings maybe, we really failed it. You can see there we've had the lowest close since we've dropped out of this pattern. I think it's significant. I think we're going to see 250 quickly and probably quite a bit lower, as low as maybe 235, 240 out of Tiger Brands. Another one that was out with weak numbers yesterday was SPAR. SPAR, you can see here, and we talked about this 2 weeks ago or a week and a half ago when we dropped the 121 level. We loved the short here below 121. We also dropped the 200-day moving average. And yesterday, even though this pattern is looking very choppy, the bottom line is, you can see here in the red bar, this is the lowest close we've had since we dropped support. I think that's significant. Also came on the back of weak numbers. Let's go out a little bit further here and just look for where we're going to be looking to potentially cover this thing if you are short. For me, it's the first level to look at all is probably 111 and a half. That's where some sort of maybe trend support comes in. I would even look a little bit lower maybe and just look at some sort of lateral support down here closer to 108. And the height of this channel here really takes us down about $15 of downside from 121, which would obviously take us down to about 106. So just keep that in mind. I think those are some of the targets we'd be looking for here if you are short the SPAR. I think that staying with the retail space and staying with that same sort of name is Woolworths. Let's just shorten this up a touch for a second here, and you can see Woolworths really dropping to new lows for going all the way back to August, and this pattern popped its head in a lot of our stocks. I'm getting ready to show it to you a few more times, but we've had this big downdraft in the market, and then we kind of get this little 4, 5, 6, 7 days of upward grinding, but not really able to make any real sprints, and then we drop off the cliff again. This is really it proves to have shaped up to be a bear flag at the moment. And I think if you back out a little bit here, this is an absolutely critical level that Woolworths has to hold. I think you can the closing lows going all the way back to I'll drew that a little bit high, but it's just below 59, call it 58 and change. Those are the closing lows. If Woolies does not hold that, the bottom could really fall out of this. I know it's got earnings quite soon, but bottom line is this is critical for Woolies. And if you look at some of the other stocks, we'll look at a Standard Bank, for instance. Okay, let's look at Standard Bank. And Standard Bank, we know how important the 120 level is over time, but also kind of a little bit of a flag pattern setting up here. It pushed back up off the lows, came back and tried to retest this level here, call it 119, kind of couldn't make it, starting to fail again. All the banks look the same. First Rand looks very much the same, potentially setting up for bear flag, and a move lower. You can see here we did test that level there, 3180, 3190, whatever. Couldn't hang on. Nedbank, same story. They're all looking very similar. They came back up to try to test resistance, and they're failing at the moment. They're failing. So I think this is incredibly important. Those interest rate sensitive stocks are still looking very, very, very weak, and they haven't really shown us any ability to give any sort of bounce in percentage terms. So this is very important. Just keep that in mind. Last one I'm going to show here is Exxaro. Exxaro potentially setting up a little bit of a head and shoulders pattern. At the moment, this thing's looking incredibly symmetrical. You can see here where the neckline is, really right here around, call it 146.5, 147. At the moment, if we were to continue to fade off of these levels, we could really see us come back and test the lows of the year, which is significantly less than this. So a lot of some bearish patterns setting up. I know that we had a big session off the U.S. market, but some of these bearish patterns are setting up, and we've rallied 1,000 points in 3 days. So it's more sector specific. Just keep that in mind, and we'll keep you up to date on how it's evolving. That's it for today, guys. Thanks a lot.